Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be taking a look at Apple stock and Chubb stock, the insurance company. It was recently announced that Warren Buffett and Berkshire Hathaway had been buying Chubb over the past couple quarters. That they had been keeping confidential so that they could build a position. And at the same time, we learned that Berkshire had been selling some of their Apple shares. So I thought it would be an interesting video to take a look at the valuation of Chubb compared to Apple to maybe give investors some insight into, what might be going on in terms of why Chubb is looking a little bit better than Apple right now. As always, this is not individual investment advice. This is just how I analyze stocks. If you do have a request you'd like me to take a look at, just put it down in the comments section. This one did not come in by request. I just made it up myself because I thought it was an interesting topic. And I'll also have links to Patreon and 25% or off discount to FastGraphs, which is one of the graphing services I'm going to use here in this video, down in the description if you're interested in those. Okay, so let's start off with Chubb. First, it was just released, I think, that Berkshire has been building a stake in the company. And it was also announced before the annual meeting last week that they had been selling some of their Apple shares. So I thought it would be pretty interesting. I went and ran the numbers on Chubb just to see what Buffett might have been looking at when he was looking at it. And it actually came in like just as kind of a classic Buffett purchase, which I thought was interesting. And I thought it would make sense to kind of compare it to Chubb. So if we look at the fast graph here, so Buffett, I think, was buying back, I think it was the past couple quarters. So let's call it in between 200 and 250 a share probably, was probably when they were building kind of their position here. So after it was announced that he had been buying it, it went up from like 245 to, I think today it's even up to 272. So it's gotten a big bump since then, but he was buying it when it was a little bit cheaper than it is right now. So that's important to keep in mind. The other thing is Chubb's an insurance company. It's based in Switzerland. It's kind of a global insurer. And this is a business that probably nobody knows better than Buffett. So he's very familiar with the insurance business and how it works and the risks and rewards that can go along with it. On the other hand, I'm a little bit more cautious with insurance companies, which will come into play here in a minute when we talk about why I didn't buy Chubb around the same time Warren was buying them. So what I have here is a graph of since 2016 through today. And while earnings are expected to fall a little bit, the last 3 years they've been really going much higher. And then they're expected in 2025 and 2026 to maybe be like 10% or so, maybe a little less than 10% in terms of earnings growth. So if we look at Apple, and the PE is about 12, even after the rise in price. I would say probably when they were building the position, the PE was probably closer to 10. The forward PE was probably closer to 10 for Chubb. So if we look at Apple, on the other hand, over the same time frame, we basically have this huge year from COVID stimulus. Okay, if we take that out, also 2018 was a tax cut year. But if we basically go back to 2019, or we kind of average all these together since 2016, and we just exclude this one, earnings growth has only been like high single digits basically for Apple. And they've been buying back a ton of stock. So actually earnings growth has been, if you exclude the stock buybacks, has been like single digits to flat. If we exclude this bump that they have here. Now the good thing is they have been able to maintain this. It didn't fall back down, which I actually thought might happen, but they have enough services revenue and they've been able to keep those customers and convert them to more Apple products. So that's allowed them to kind of maintain basically the earnings growth that they got during COVID, which is good. But really, Apple's earnings growth is pretty flat, honestly. I'm going to assume it's 10% because I try to be Kind of if I feel if it looks pessimistic, I try to be optimistic, and if it looks too optimistic, sometimes I take the more pessimistic view. But it basically trades at like a 30 PE, so it's 3 times more expensive, just not including earnings growth, as Chubb. So let's look at my spreadsheet here and compare the two of them. So I assume that Chubb is going to grow earnings. This is based on the 20 earnings since about 2016 for these guys. And then for Apple, I told you I was generous and assumed 10% earnings growth. So earnings growth is pretty similar for both of them. Chubb's, my assumption is they'll grow a little bit slower, but not too much. Revenue growth kind of tells the story. This is the past 3-year revenue growth for Apple is about 10%. It's 3 times faster for Chubb. So that kind of shows you in terms of like top line growth, Chubb's actually growing fast, has been growing faster than Apple. Now, so this is where the valuation comes in. So that puts Chubb on if we assume they earn $21.75. So let's Apple I have at $6.58. Oops. I just want to check that earnings number real quick. So $21.75 is what we're expecting for Chubb in earnings going for forward earnings, okay? That translates to, let me move my head here real quick, to about a 12 PE, all right? 12.5 PE. So that brings Chubb's earnings yield at about 6.87%, and Apple's earnings yield, because the PE is so much higher, at over 30, to only 3.39%. Okay, so the way to think about this is, and we're going to look at them side by side so you can kind of see the difference. If you bought Chubb for $100, they would make about $6.87 in earnings on that $100 from their business. Apple would make about $3.39 on that $100. Now, using my estimates, this $3.39 would grow at 10%, while this $6.87 would only grow at 7.7%. So this is a lower starting number, but it's going to grow a little bit faster. And this is a higher starting number, but it's going to grow a little bit slower on that $100. So what I want to see is over time how much a business owner could collect in earnings from these two investments, given the assumptions that I've just laid out. And I would say the assumptions are pretty optimistic for Apple, but they could invent some new product or whatever that we are not thinking about right now, or maybe Vision Pro takes off or something. They're pretty good at coming up with new stuff. So it's possible that over the next 10 years, they come up with something that kind of spurs more growth, and we just don't know what it is. So I'm giving them credit for that. But if we take these assumptions and we work them out for 10 years to see how much money we would collect over that time, if you started with $100 in Chubb, you would end with $205. If you started with $100 in Apple, you would end with $159. And when you convert that to a CAGR, you get a 4.78% CAGR for Apple and a 7.48% CAGR for Chubb. Now, my threshold for a buy here is 8%, and at $249, Chubb would have been at 8%. So that was actually about the price that and below where Buffett was buying it. So he's kind of probably using some similar type of valuation process. Whereas Apple, the returns are nearly half that, so you could even pay taxes on your Apple and still have enough margin of safety left over to buy some Chubb, where the future returns are better. Now, I think the obvious question here would be, Corey, why didn't you buy Chubb? You track it. You're probably looking at it. Well, at the time, my earnings growth was a little bit less than that. They've come in a little bit better since I updated it. So that was one reason. But the main reason was right now I have my recession parameters on, and so you can see I used a blend of 2009 and 2020 for my recession expectation, which we haven't had. And so I was aiming to get a potential lower price. But the standard price would have been just fine. Now, Buffett's doesn't really do that. He doesn't he has the prices that he wants, whether it's recession or not. He's looking at the very long term. And as long as he can get the price that he wants, that's what he'll do, especially when he has a lot of cash that he wants to put to work. So, and Chubb, his options are a lot more limited than mine. I mean, Chubb has like a multi-$100 billion market cap, right? So the market cap is $100 billion. So Buffett can put money to work there, whereas Apple's like in the trillions now. Whereas I can invest in really small companies that he just can't. So I have more opportunities. I can be pickier. I can aim for lower prices. And I think once he's on about 20% cash, he's really looking to whatever opportunities he can get. If he thinks he can get an 8% plus inflation return on a solid business that he understands, he's going to do it. And I think that's what he did. And when the returns of Apple, a huge position right now for Berkshire, are looking pretty low, and then there's also China risk involved. I think the combination of those two things together just made Chubb look like a better investment. So it's really that simple. I mean, and that's why I decided to make this video, because it really shows you the power of running the numbers, having a valuation process, and like this doesn't look like much of a difference, but when you compound this out over 20 years or something, I mean, it's a huge difference. So, Warren would triple his money potentially from the earnings of Chubb over that time. And I'm not sure, well, we can see. Let's just look at my spreadsheet and see how long it would take to, I don't go all the way out. I think I only go to 20 years on this chart. Yeah. So yeah, it would take you, in 20 years, you would triple your money with Apple, but you would quadruple it with Chubb. A little bit more than that, actually. So that's a big difference, right? And especially when you're looking at the very long term, like I'm sure in general, just when you're projecting out, Warren's probably doing. So hopefully you found this useful. I'll let you get into the mind of what Warren's thinking, and why I didn't particularly buy it. I'm also a little bit cautious with insurance companies, and you can think about how just making sure you have a process of kind of making sure the numbers work, and when they get really far apart, like Apple and Chubb, it's okay to take some money from the business that's really priced high, valuation is very high, to one where the valuation is not super cheap, but enough where you can make a very solid, dependable amount of money. If you found this video useful, hit the subscribe button, hit the like button. I'm putting out about 5 analysis videos a week now, and I'll see everybody later.